They rise fast, fueled by hope, hype, and hysteria. And when they burst, they leave behind economic devastation, broken dreams, and hard lessons that are too often forgotten. This is the story of economic bubbles, one of the most compelling and destructive patterns in financial history. Bubbles aren't just about numbers or assets. They're about human behavior, greed, fear, and the dangerous power of collective belief. In this video, we'll take a deep dive into how and why these financial mirages form and why they continue to repeat over and over again. An economic bubble begins when the price of an asset rises significantly beyond its intrinsic value. That asset could be anything: real estate, stocks, technology companies, cryptocurrencies. At first, the rise seems logical. There's often a real innovation or opportunity at the core, but what starts as rational investment quickly turns irrational when speculation takes over. People begin buying not because they believe in the value of the asset, but because they believe someone else will pay more tomorrow. This is known as the greater fool theory, the idea that you can always sell to someone even more optimistic or more foolish than yourself. The psychology behind this is fascinating and dangerous. It all starts with optimism. A new technology emerges. A company posts big gains. The media picks up the story. Investors jump in. Prices rise. At this point, gains feel justified. But then comes euphoria. Everyone wants a piece of the action. Friends, coworkers, celebrities, influencers. Suddenly everyone is talking about the next big thing. FOMO, the fear of missing out, spreads like wildfire. People abandon caution, taking out loans, selling their belongings, even quitting their jobs to go all in. Greed overwhelms rational thinking. It feels like a new era, like the rules of finance no longer apply. Eventually, the cracks begin to show, but investors are deep in denial. They say it's just a temporary dip, a correction. They double down. But behind the scenes, the foundation is crumbling. Then something triggers panic. Bad news, rising interest rates, a major investor pulling out. Fear replaces greed. Suddenly, everyone wants out. Selling begins, prices collapse. What once took years to build evaporates in weeks or even days. Fortunes are lost, markets crash, and the aftermath affects not just investors, but entire economies. History offers us many examples. One of the earliest and most notorious was Tulip Mania in 17th century Holland, when tulip bulbs had become symbols of status and wealth. Prices rose to stratospheric levels. A bulb could cost more than a house. But in 1637, buyers vanished, prices collapsed essentially overnight, and many were left financially devastated. Then there was the South Sea Bubble in 1720, when a British trade company's stock rocketed on the strength of exaggerated claims. Politicians and citizens invested heavily, but the company had no profits. When reality struck, the collapse was swift and brutal. Flash forward to the 20th century, and we see the same story repeat itself with the dot-com bubble. In the latter half of the 1990s, internet companies with no more than a plan and a web page were worth billions. Everyone was convinced the internet was going to revolutionize everything, and it did, but not all companies made it through. When the bubble burst in the year 2000, $5 trillion in value was lost. Only 8 years later, the housing crisis in 2008 showed us how even more seasoned markets are not safe. Bred from cheap credit and subprime mortgages, housing values spiraled. When defaults began and banks started to fail, the global financial system was at meltdown. Millions lost homes, jobs, and savings. Even today, the same cycle repeats. Bitcoin and altcoins were flagged by explosive highs, followed by cringeworthy busts. Meme stocks in the likes of GameStop stock and AMC stock surge as a result of hype and online forums, unconnected from economic fundamentals. The same new era bubbles occur in a flash more quickly than ever before, thoroughly fueled by social media, algorithms, and real-time global communications. But underneath, they are fueled by the same emotion-based narrative as ever. What's so dangerous with bubbles is not merely the economic destruction they leave in their wake, but the deception they create. They make folks believe they're getting rich, they've made a discovery, this time it's different. And they all share one ultimate consequence: in fear, regret, and the dismal awareness that value premised upon fantasy can't last. For all we've learned from history, we're condemned to keep making the same mistakes again and again, because we're motivated by emotion, not by logic, because we crave certainty in a world we can't control, because we all, in private, hope in the promise until it becomes a nightmare. Studying the psychology of bubbles not only helps when we deal with the marketplace, it helps when we understand ourselves, our vulnerabilities, our desires, our collective susceptibilities. And maybe, just maybe, it helps when we remember when things sound too good to be true. They probably are.